Namaste, I'm Umesh from 361 Asset, and I'm here to talk about a subject that I personally am very passionate about, which is investing in late-stage and pre-IPO companies. So let me start by showing you images of this movie, and I would like to ask the audience, how many can guess which movie is this? And can you take 30 seconds to say what this movie was about? Yeah, so what happened in this movie was there is one very happy family, which is a Khosla family in Delhi. They have a dream to own their own house, and they buy a plot of land from the local broker. And when they go to start building their house, when Mr. Kishan Khurana comes and he shatters their dreams. So you must be wondering what I'm doing talking about Khosla in a very serious investor conference. So the reason is that there is a lot of similarity between what has happened in this movie and with pre-IPO investing. There's a lot to learn from here so that we don't make these mistakes. So now coming to the normal ritual of some boring PowerPoint slides. So private companies offer a very large investable universe. There are about 2,250 companies listed and traded on the National Stock Exchange. But if you leave aside the large and the mid cap and you look at 250 to 1,000 companies and you put a threshold of 50 crore or $6 million of EBITDA, you will find a little over 600 companies to invest in. But when you apply the same threshold of EBITDA of 50 crores in the private universe, you get more than 1,300 companies to invest. And many of these companies are selling products which you and I consume on a daily basis, like Book My Show, Haldiram, Winnie Cosmetics, and many more such names. And private companies, at the growth stage, they raise more funds in private market than in IPO. So annually in the last 3 years, on an average, these companies have raised, they have raised $10 billion through 50 IPOs, whereas in the private space, they have raised 23 billion through 170 transactions. So it's a much more vibrant universe that you can participate in. And these growth investment opportunities, they come across sectors. No one sector dominates more than 25% of the deal flow. So you can actually build a very diversified portfolio of private companies which are headed to the capital market. These private companies, most importantly, offer you the opportunity to invest in innovative business models which are not available in public market. So I would just like to ask a question again to this audience. How many of you have invested in the IPOs of companies which is there in the center column, which is 𝐚𝐬𝐽's, Keynes, Tech, Tata Tech, and Prudent? So I would like to ask you, would you not have liked to invest in these companies when they were private? Exactly, yes. Because these companies offered you, even when they were private, a very proven business model, positive unit economics, decadal growth opportunity, and at the late stage or pre-IPO, they also reduce your investment risk. As you know, India has more than 100 unicorns, of which about 25 are publicly listed. And the experience of with learning from the experience of the early unicorns which got listed, these companies are now adapting their business models to become more suitable for public markets. So therefore, the space now offers a huge opportunity to participate in them when they are at this late stage or pre-IPO, to participate when they are at this late stage or pre-IPO. The private companies always tend to grow faster than their listed counterparts. So if you look at the data, from FY18 to FY23, the listed small cap universe that I referred to in my earlier slide, that grew at 9.5%, whereas the private companies grew at 15%. And the reason for that is that listed companies, they have to live their life quarter tak, balancing growth and profitability, whereas private companies can continue to invest in developing new products, new markets, without these short-term pressures. And there are many such examples. I won't get into names, but across hospitality, consumer discretionary, software, financial services, healthcare, where very prominent companies slowed down in their growth, both in revenue and in earnings, after they got listed. Now, all that I've said so far sounds very good, but the key to investing in private companies is to be very disciplined while you price them. Because these companies are chased by large pools of capital, they demand very high valuation because there is going to be very high growth. Hence, the top filters that you must keep in mind when investing in pre-IPO companies is very high visibility of earnings growth. 2, business model must be amenable to the public markets. And 3rd, there should be very limited peer set to those companies when they will come to the IPO market. And if you're able to check these 3 boxes, then very highly likely that even though you may have paid near IPO market valuations, right, to price these companies for the high growth, you will see a valuation re-rating in the public markets, and that is evident in many examples like Medanta, 𝐫𝐞𝐠𝐿, Cremica, or very recently a company called TBO and Prudent, and many more such examples. So all this pain of going through so many private companies, what is the return that you can expect? So let's look at what is the rolling CAGR of investing in mid and small cap indexes. That has been in the 12 to 14% over the last 7-year period. And the reason I talk about 7 years is because most of the funds that invest in private companies are tenured as 5 to 7 year funds. Of course, the return has been much higher in the last 3 years, but when you look at longer periods, the returns are far more moderate. So as many of you might know, there is a BSE IPO index which tracks how the IPO companies stock prices perform after listing. So in the last 7-year period, the S&P BSE IPO index has delivered an IRR of 20%. So public market listed companies in the mid-teens, IPO companies at 20%. What can you expect by investing in late stage and pre-IPO? Perhaps around 20 to 25%. Let's take the example of a company like ICICI Lombard, which listed in September 2017. Again, a large sector, decadal growth opportunity, a very limited peer set. So an IPO investor from then to today, over a 7-year period, has made a 20% IRR, which is much higher than the average market. But a pre-IPO round that happened a few months prior to IPO, that investor has an enhanced IRR of 26%. So that's the delta that I'm talking about when you invest in late stage or pre-IPO companies. And there are many more such examples, but I won't get into detail given the shortage of time. So you can see similar data for Zomato, for KFinTech. Now we'll go back to a story of 𝐶𝐽. Everything that I've said, it sounds absolutely interesting, but I want to ask a question again to your audience. When you invest in pre-IPO situations, what should be the first filter? Absolutely. Where is the exit? Exit कैसे मिलेगा? And that's exactly what happened in this movie when Mr. Khosla, he had to go back to his broker, and as you know, the broker was not able to help. He had to go through some ingenious ways to find an exit. So I want to ask the audience again, how many would you have invested in the companies which are there on the right side of the slide? So, I think most of these companies are doing very well in their business, nothing wrong with them, but for some reason or the other, due to maybe external reasons, they have not been able to IPO. Or IPO has got significantly delayed, which means that when you now want to exit, you have to call the broker, and whatever price he quotes, you have to go with it. It will be opaque. You will never feel confident that you got a fair price at the time of your exit. But things are changing. The private company, the exit market has matured significantly. As you can see, there were 176 exits in 2018, and that number has moved to more than 300 in 2023. And that's not it, but very interestingly, now nearly 50% of these exits are in through secondary sales and the strategic sales, and you're not just dependent on an IPO market, which can be very volatile. So can you afford to miss this large private market opportunity? If you look at the NSE market cap today, 10% of the market cap, which is close to $550 billion, is contributed by 239 companies that listed in the last 5 years. More than 400 companies have raised in excess of $40 billion in the last 3 years in private market, and many of these companies will come to the market in the next 3 to 5 years and will create a possibility of adding another couple of $100 billion of market cap. So the whole idea is to catch these companies young when they are unlisted, and that's the opportunity that I'm talking about. So, should you invest in pre-IPOs directly or go through an asset management company? I think the advantages are clearly that an AMC has the wherewithal to source deals of a variety of kinds, to have price discovery at the time of making the investments, do a full diligence, to have corporate governance post-investment, and most importantly, ensure there is a price discovery at the time of exit, and not just be dependent on IPO or a secondary sale, but even have the option to explore strategic sales. So a little bit about us. In the private space, we currently have a live AUM of $3 billion after returning $2 billion in the 7-year history that we have. We currently have 122 portfolio companies, of which 30 are unicorns, which will look to list in the next 2 to 3 years. We have made 15 investments in FY24. We exited out of 20. We are a 32-member investment team. We have a journey of many firsts. We launched the first India Secondaries Fund in 2024. We have the first multi-asset fund for private investors. We have the first pre-IPO fund way back in 2017, and the first private fund of fund in 2018. With us, you can invest right from pre-A rounds up to pre-IPO. We primarily invest in a few verticals, which is tech, FS, healthcare, consumer, and industrials. So I invite you to dream like Mr. Khosla and dream those dreams with us, and please connect with me offline.